You're profitable on paper, so why is the bank account empty every month? This is probably why. Here is what most business owners don't realise. Profit and cash, they're not the same thing. Your profit and loss says that you've made money, and your bank account says you didn't. And both of them, they're right. I see this all the time. An owner shows me their profit report. Healthy margin, good growth. Then they open the bank account. There's nothing there. The gap between them isn't a discipline problem. It's a setup problem. There are 4 timing gaps that eat your cash. Every single one is structural. None of them show up on a profit report. The first gap is that your clients pay late. So you did the work in January, they pay you in March. The revenue shows up in January's profit and loss. The cash shows up 60 days later in March. Your accountant records the revenue when the work was done, and that's correct. It's how accrual accounting works. But the bank doesn't care about your profit and loss. The bank only cares about when the cash actually arrives in your bank account. Gap 2. Your expenses, they're immediate. Rent, software subscriptions, wages, superannuation, they hit on schedule. Day 1, day 15, day 30, there's no 40-day float, no grace period. When they're due, they're gone. So revenue lags, expenses don't. And that's the first squeeze on your cash. Gap 3, you're buying ahead of revenue. So if you sell a product, you buy stock before you sell it. If you run projects, you buy materials before the job starts. If you use equipment, you buy or lease it before it earns a cent. The cash goes out weeks or months before it comes back in. And the bigger you grow, the wider that gap gets. Because you need more stock, more materials, more capacity ahead of the revenue it generates. Gap 4, tax and big bills, they land in lumps. Regular tax payments, activity statements, superannuation, insurance, annual licenses, they don't spread evenly across the year. One quarter looks fine, the next one wipes out your entire buffer. And here's the trap. If you've been spending based on what's in the bank right now, you've already spent the money that's meant for those lumpy bills, because the bank balance doesn't tell you what's owed next month. So let me say that again. Your profit report says you're healthy. Your 4 timing gaps say you're not. And both are true. That is not a discipline problem. It's a setup problem. So here is what fixes that. A weekly cash rhythm. Same time every week. Monday morning, 10 minutes. Step 1, check what's actually in the bank right now. Not what should be there, not what your accounting software says, but what is actually sitting in the account. Step 2, list what's coming in this week. Not what's owed to you, not what's on the books, what's actually going to land in your account this week. Confirmed payments, scheduled transfers, deposits in progress. Step 3, list what's going out this week. Fixed costs, variable costs, wages, super, loan payments, software, stock orders, everything that will leave your account between now and Friday. Step 4, subtract. If the number's positive, you have a good week. Don't spend the surplus. That's next month's buffer. If the number's negative, you have a decision to make before Wednesday. That's it, 4 steps, 10 minutes every Monday. This is something I see all the time. Owners who check cash weekly never get surprised. Owners who check cash monthly always do. And the ones who don't check at all, they're the ones calling their accountant in a panic, asking how they're profitable but can't make payroll. Monthly reporting, it's great for tax, but it's useless for survival. And by the time your monthly report says there's a problem, the problem was 3 weeks ago. You can't steer a car using last month's GPS. Think about it this way. Cash flow moves in days. Your reporting moves in months. That's a 30-day lag between what's happening and what you know about it. The other thing the weekly rhythm does is it forces decisions early. If cash is tight this week, you see it Monday. You can push a supplier payment out a few days. You can chase an invoice today, not next week. You can defer a non-essential spend. On Friday, none of those options exist. The money, it's already gone. But there's a second piece to this, and it's the piece most owners never get to. Most owners track lag indicators: revenue, profit, bank balance. These tell you what happened, they don't tell you what's about to happen. Lead indicators, they do that. For cash, lead indicators are things like how many invoices are overdue right now, how many quotes are outstanding, work you could win but you haven't. What's the average time between doing the work and getting paid? What fixed costs are locked in for this month regardless of what revenue does? These predict next month's cash. They don't appear on any standard profit and loss. And most owners, they've never looked at these. If you want to predict cash problems before they arrive, track 5 numbers. 1. Days sales outstanding. How fast your clients actually pay. Not your payment terms, the real number. If your terms say 14 days and your client's paying 38, that gap is a cash problem. 2. Overdue invoice count. How many invoices are past due right now? Not the dollar value, the count, because each overdue invoice is a relationship to manage. 5 overdue invoices is 5 phone calls. 3. The pipeline value. This is the work that you have quoted but not yet won. This tells you what revenue could arrive in the next 30 days if you close it. It also tells you how much of your upcoming cash is certain versus hoped for. 4. Commitment density. And this is something that nobody tracks. How much fixed cost hits this month regardless of what revenue does? When we talk about fixed costs, we're talking about things like rent, leases, wages, software, loan repayments. Add them up, that number is your minimum. Cash income, cash being received, has to beat it, or you're going backwards, even if your profit and loss looks fine. 5. What we're looking at here is cash buffer days. How many days could you operate if nothing new came in tomorrow, no new receipts tomorrow? If the answer is less than 30, you don't have a buffer, you have a delay, and any disruption lands directly in your operating cash. These 5 numbers give you something your profit report never will. They give you an early warning system. Now, you don't need a dashboard, you don't need software, you need a piece of paper and 10 minutes on Monday. This kind of information, this process, is the Tools and Numbers module from the Business Planning Operating System. So one of 9 modules, this full system connects strategy, priorities, execution, cash and team into one weekly rhythm. If you want the complete system, I've put the link in the description. Let me show you how this actually works in a real week. On Monday, you do your 4-step cash check. 10 minutes, what's coming in, what's going out and what's left. You notice 2 invoices are overdue. Now that's a lead indicator firing. So chasing those 2 invoices becomes your first action on Monday. Not next week, not when it's convenient, Monday, because the longer an invoice sits unpaid, the less likely it ever gets paid. Wednesday, halfway through the week, you check, did those payments arrive? Yes, you're on track. The week balances. No, you now have 2 days to adjust before anything bounces. So your options on Wednesday: push a supplier payment back a few days, call the client again, transfer from savings, defer non-essential spending. On Friday, your options are none. The money's already left. On Friday, you close the week, and what actually came in and what actually went out. What did the week balance? Update your cash buffer number, and that becomes next Monday's starting point. Now, this whole cycle takes 20 minutes a week, and it eliminates the biggest cash problem most owners have, and that's surprise. This is what I see regularly happening in businesses. An owner gets a big payment, things feel great. They spend it on something they've been putting off: new equipment, a marketing push, hiring someone. And then 2 weeks later, a tax bill lands, or a big client delays, or a quarterly superannuation payment is due. And they're scrambling. They're looking for money that was there 2 weeks ago. Now that cycle of feasting, spending, scrambling, it isn't a cash flow problem. It's a rhythm problem. It's a structure problem. And without that weekly check, you're always reacting to whatever just hit your bank account. You see the money sitting there and you think you have it. You don't. You've already committed it. You just don't know it yet. Now, with a weekly check, you make decisions based on what's actually coming and what's actually owed. The rhythm breaks the feast, spend, scramble cycle, not by giving you more money, but by giving you better timing. There's a specific move that fixes most small business cash problems, and I call this the timing adjustment. Most owners try to fix cash by selling more. More revenue will solve it, right? Well, sometimes it does. But often the revenue, it's already there, it's just arriving at the wrong time. The timing adjustment works like this. We move cash inflows earlier. We change your payment terms from 30 days to 14. Maybe we offer a small discount for early payment. We send our invoices the moment the work is done, not at the end of the month. Every day you shave off your collection time is a day your cash arrives sooner. We can move cash flows out later, negotiate longer terms with suppliers, schedule big payments for the week after a major receipt, and batch variable expenses into weeks where cash is strong. Don't pay early just because the invoice arrived early. Space out those lumpy bills. Ask your accountant about your regular tax installments and variations. Set up monthly transfers for annual costs like insurance, and break those big quarterly hits into smaller monthly hits. This isn't theory, it's very simple maths. If money arrives 3 days earlier and leaves 3 days later, you've just built a 6-day cushion of cash without earning a single extra dollar. And that's the power of timing. And it only works if you check cash weekly, because you can only adjust what you can see coming. Now, 3 mistakes I see with cash rhythm. The first one, mistake number 1. Checking cash when you feel like it. That's not a rhythm. That's called panic. Instead, pick a day, pick a time, do it every week no matter what. The consistency is what makes it work. A random check catches problems after they've already happened. A weekly rhythm catches them before. Mistake 2 is checking the balance instead of the timing. Your bank balance today doesn't tell you what's due on Thursday. A client might owe you $20,000, but if it arrives next week and your tax installment is due Friday, the balance today is irrelevant. You need to know what's coming in, not just what's sitting there. The third mistake is trying to do it all alone. If you have a bookkeeper or an admin person, they should prepare the numbers Friday afternoon. You review them Monday. That's 5 minutes, not 10. And they'll probably do it better than you. And that's because they're not emotionally attached to the numbers. Cash rhythm, it doesn't exist in isolation. It connects to your weekly priorities. And if cash is tight, that changes what you do this week. You chase invoices before you do anything else. You chase invoices before you write content, before you do marketing. It connects to your quarterly plan. And if you're always tight, you can't invest in growth. You're stuck in survival mode. It connects to your team. And look, if you can't make payroll, nothing else matters. And it connects to your exit. A business with predictable cash sells for more than one that's always scrambling. And this is why the weekly cash check is one module in a full system. It works on its own. It works better when it's connected to strategy, priorities, and execution. Owners who manage cash in isolation, look, they only fix today's problem. But owners who manage cash inside a connected system, they prevent next month's problem. Here is the shift that you need to make. Most owners manage cash by feel. They check the bank, they check the gut, they hope for the best. Owners with a cash rhythm, they manage by timing. They know what's coming in. They know what's going out. They decide early. And the difference isn't more revenue, it's better information. And that information takes 10 minutes a week. What we've covered is the tools and numbers module from the business planning operating system. There's 9 modules, 1 weekly rhythm, strategy, cash, priorities, team, they're all connected. And if you want the full system, the link's in the description. I encourage you to check that out. Have a look at what's involved. And if this is the first time you're seeing this, that weekly cash check, that's where you start.